Hello and welcome to We Mean Business. Lots to discuss today on the show. We'll be focusing on two issues instead of one: the PMESC's growth forecasts and the overall macroeconomic situation. And the bigger theme in the backdrop of divergent software company results, where the Indian IT needs a reboot. The big four are out with their numbers. What are some of the trends? What's the road ahead? And whether it's time for Indian IT to reinvent itself. Joining us on the show, Saugata Bhattacharya, Senior VP Business and Economic Research at Axis Bank. He'll join us for a quick take on the PMESC's forecasts. On the IT debate, we have Arup Roy, Principal Analyst from Gartner, joining us from Mumbai. TVS Mohandas Pai, Chairman of Manipal Global, joins us in a link from Bangalore. And Siddharth Pai, President, Asia Pac at Information Services Group, joins in also from our Bangalore studios. We'll also play out the conversation I had earlier with Som Mittal, the President at NASSCOM. But first, the PMESC's forecast for FY14. It sees GDP growth for FY14 at 6.4%, the CAD at 4.7% for the next year, and WPI inflation at 6%. So no big surprises. And the general view is that the PMESC has been cautious and realistic in its forecast. Here are C. Rangarajan speaking to my colleague Sapna Das.
We have taken into account the more recent developments. We have looked at the factors which have contributed to the low growth in last year. We think many of those reasons are not present in the current year. A lot of measures had been taken since September in order to improve the investment sentiment. The full impact of those measures will be felt in the current fiscal year, and therefore we think the expected rate of growth of 6.4% is well grounded.
Right. So in that sense, the worst is over, and also with the overall commodity prices coming down, it's going to have a healthy effect on the fiscal deficit numbers, inflation numbers, the CAD numbers.
I think the slow phase has bottomed out, and we are in a phase where the growth is improving. I think while the international economic situation in terms of the performance of the economies, advanced economies, is not good, but the international prices, commodity prices particularly, show a downward direction. That will be good for India's balance of payments. That may also have a favorable effect upon India's inflation.
And that's expected to continue, sir? This is expected to continue, sir, the downward...
Well, I think some commodity prices have fallen very steeply, but they may remain more or less at this level.
Okay, that's the PMESC chairman speaking to my colleague Sapna Das. But I also had a chance earlier to speak with Saugata Bhattacharya, Senior Vice President, Business and Economic Research at Axis Bank. I began by asking him for his initial thoughts on the PMESC's growth projections, whether 6.4% for this year was optimistic given that it's higher both than the IMF projections and than the economic survey. Listen.
Yes, I do think, it's realistic in the sense that within a realistic band, maybe a little bit on the optimistic side. But remember, this is even the economic survey was exactly in this range, 6.1 to 6.7. And even the last set of economist surveys that I've seen pitches it about 6.4. My sense is that given what we are seeing in terms of potential export growth next year, and uncertainty about the economic environment, that maybe growth might come in a little bit lower. This, of course, presumes a normal monsoon, which we are getting to hear we might actually get this time. But even the 3.5% agricultural growth sounds a little high. The services growth of 7.7% is likely to turn up on the higher side. But with a couple of percentage points here and there, it's not that big a concern. But if it reflects their knowledge and they have a fairly large insight on thinking on government policies and so on, if they are factoring in whatever they understand in terms of the reform measures being put out by the government, then I think it's completely doable. If the yesterday's Cabinet Committee of Investment decisions on petroleum projects and power projects, if things like this begin to roll through the rest of the year, then a 6.4 is perfectly possible.
Mr. Bhattacharya, what do you make also of the commentary on last year's numbers? Rangarajan saying there's a case to upward revise the 5% that we've reached to bottom. There's a case to upward revise manufacturing numbers. What's the sense you're getting? Have things changed significantly on the ground to enough this, to warrant this kind of commentary?
Two parts to the question. One, can there be an upward revision? It's possible, because I mean the reason that they have given out that the actual corporate sales data that we've seen for the first 3 quarters of the year, in previous years it has actually mirrored the annual survey of industries numbers rather than the IIP data, which has typically been higher. So if the corporate growth numbers that we've seen actually is a reflection, then maybe the IIP numbers will get reflected upwards. Having said this, I don't really see any sign of any revival in industrial activity. The IIP numbers are already out, and the situation on the ground, what we are seeing in terms of credit, what we are seeing in terms of logistics numbers, etc., does seem to point that the 5% growth is probably closer to ground reality than a 5.2 or a 5.3.
What about exports? 9%, imports 8%. Can global demand, or rather the global demand environment at this point in time, support this kind of growth? The IMF, of course, has recently downgraded global growth. So is this a bit optimistic, do you think?
I think that's the most problematic part of the report. Overall, the report, I think, is much more balanced and realistic than the last 2 or 3 set of numbers that we had seen. But the export numbers, I think, is very aggressive. It's almost 330 billion from about 300 billion that we have seen this year. I find it really difficult to imagine that exports can grow that rapidly in a global environment where global trade is expected to grow, we remain flat or grow by 1 or 2%. Because a large part of the export growth that we had seen in the last 2 previous years apparently came out of diversification of geographies, of destinations, and that might actually have played out. I don't think there will be much room. So our sense is that both exports and imports would be lower than the numbers that is given out by the PMESE. So while that definitely has growth implications in terms of the trade deficit that the PMESE has come out with, the trade deficit might actually remain pretty much the same, or might even come down a little bit.
But what bearing does it have, sir, on the current account deficit? The PMESE is saying the number could be at about 4.7% for the next year, 5.1% for this year. They're also saying they expect gold imports to come down. Now, where do you see the CAD if gold prices remain stable? Because a lot of economists also saying that they expect a better number than what's being projected.
Our Axis Bank's estimates are also very close, 4.6%, a CAD deficit of 4.6%. It's really difficult to say, because I mean all of this is the more optimistic numbers that we are seeing right now are emanating from the lower commodity prices that we are seeing globally. So many people are expecting that the oil import bill, say for instance, would be much lower, and particularly if the government carries through on the energy deregulation program, where diesel is repriced and so on. Having said this, I'm not very sure how long the low commodity prices are likely to sustain. So given this, given the uncertainty regarding the volatility of commodity prices, my sense is that this is a good working number to start with. A number around 4.6 to 4.8%. Things can move any which way. If domestic growth begins to pick up and there remain various supply bottlenecks, then we might actually see more imports to meet some of that demand. So given this, if anything, the way things are moving in the country, I think there's a risk of the current account deficit actually becoming a little worse rather than a little better.
Right, so your forecast and your take also on the 6% inflation target, is that realistic? Is that also cause for comfort if the CPI number continues to remain high?
I think you're absolutely right that the 6% number, although our Axis Bank's estimates are also 6% on an average, closing the year at about 7.1 or thereabouts. I see that the food inflation numbers have been put at 8%. So which is an approximate indication of where the CPI numbers are likely to remain. Given what we now understand in terms of food inflation, primary commodities and so on, I think this is a realistic estimation that CPI would probably average around about 8.5% for the year, which is their estimate of food inflation. And WPI inflation, provided all the assumptions that we are now making on commodity prices, local demand and so on, all of these actually turn out to be correct, should probably average around about 6% in FY14.
Right, so WPI at 6, CPI likely to trend down, CAD contained. What does all of this mean for RBI action? You have the monetary policy in May. What's your sense and what would happen there, and then also through the course of this year in terms of rates?
These numbers indicate that some room has opened up for the RBI. Probably still very limited. I mean, even if you are seeing a 6% WPI inflation and 8% CPI inflation with a CAD about between 4.5% to 5%, the room is still limited, but the situation has definitely become, in terms of monetary policy easing, I'm saying, situation has improved over what we were seeing just about even a month back. So our expectation is that they would still follow a gradual trajectory of rate cuts. Probably 25 in the beginning of May, probably another 25 somewhere in the first quarter or early in the second quarter. As of now, we think that there is room for the RBI to cut by about 50 to 75 basis points. But if commodity prices still remain relatively contained, then we might actually see a somewhat steeper set of cuts, probably going up to 100, 125. But as of now, I think the highest probability is for a 50 to 75 basis point cut over the course of the first half, or maybe into the third quarter of the year.